On Monday, May 11th, silver surged 6.15% in a single session. On the same day, gold shifted just 0.39%. Silver outpaced gold by a factor of 16. Yet, almost nobody reporting on precious metals explained the move in a clear way. By May 21st, silver had fallen back to $75.46 per ounce, down $12 from its peak. The same analysts who ignored the move up offered nothing on the pullback either. Here's what actually happened. Silver is not trading like a typical precious metal. Right now, it acts as a real-time indicator for the global AI supply chain. Understanding this distinction is crucial to predicting what comes next. In mid-April 2026, the gold-silver ratio, the number of ounces of silver needed to buy 1 ounce of gold, was above 61. This ratio matters because it shows whether silver moves with gold due to safe haven demand or moves independently for industrial reasons. When both metals react to fear, the ratio remains wide. When industrial demand drives silver, the ratio narrows. Between mid-April and May 11th, the ratio compressed from 61 to 55.46. Silver did all the work, gold barely budged. This was not a fear-driven trade, but a repricing due to industrial demand, occurring even before the summit began. On May 11th, silver jumped 6.15% to $85.36 per ounce, while gold moved less than 0.5%. By May 14th, the first day Trump and Xi met in Beijing, the ratio had narrowed further to 55.25. Observers focused on the ratio rather than just prices saw a clear signal. Approximately 60% of annual silver demand is industrial. Electronics, semiconductors, solar panels, electric vehicles, and AI data center infrastructure, not jewelry or coins. Most of these supply chains run directly through US-China trade. When relations improve, manufacturers plan higher production, increase forward purchasing, and build inventory, pushing silver demand up without affecting gold. Solar photovoltaic production alone made up 29% of silver industrial demand in 2024, up from 11% in 2014, driven by global solar expansion. AI data centers represent the next wave. High-performance chips require silver and thermal interface materials to prevent overheating. Silver's unmatched electrical conductivity and performance make it irreplaceable in modern AI hardware. Each new data center and rack of GPUs increases baseline structural demand, which already exceeded global mine supply before geopolitical factors emerged. The Trump-Xi summit ran May 14th and 15th. It was the first U.S. presidential state visit to China in nearly 9 years. Jensen Huang of NVIDIA, Tim Cook of Apple, and Elon Musk attended. The technology and commerce delegation emphasized semiconductors, export controls, and AI supply chains. Wall Street expected that a meaningful deal, an extended tariff truce, eased chip export restrictions, or normalized critical mineral trade, would push silver higher. Goldman Sachs projected a delay rather than a deal, but market optimism still drove silver from $75 to $87 in about 2 weeks. The summit concluded, and headlines confirmed that Wall Street found no substantive agreements, with trade talks narrowly focused and no decisions on AI's future. The NVIDIA H200 chip sales, reported as cleared on the first day, faced complications. China declined broad purchases, telling Trump that Beijing wants to develop its own. Silver sold off, naturally. The trade that lifted it from $75 to $87 was a positioning trade, a bet that the summit would bring supply chain certainty for manufacturers reliant on U.S.-China commerce. When the summit delivered less than the rally expected, the trade reversed. Prices returned to their starting point. But the story is not that simple. While markets focused on the diplomatic summit in Beijing, an event occurred in eastern Kazakhstan on May 5th that barely made headlines. A dust extraction unit exploded at Glenor's Kazzinc facility, Instinct's largest producer of zinc, lead, copper, gold, and silver. 2 workers died, 5 were injured. Part of the building collapsed. Rescue teams spent days searching the rubble. Kazakhstan's Emergency Situations Ministry confirmed the blast. As of this week, there is no timeline for operations to resume. Glenor, owning 70% of Kazzinc, was already negotiating a $4.5 billion sale of the facility, which is now complicated. The operational status is uncertain. Kazzinc produces millions of ounces of silver annually as a byproduct of zinc and copper operations. The Silver Institute and Metals Focus had already flagged that total silver supply would fall by 2% in 2026. That projection predated the Kazzinc explosion. The supply outlook just tightened, yet the price reacted to a diplomatic outcome thousands of miles away in China. Structurally, the World Silver Survey 2026 confirmed what the previous 5 surveys showed. 2026 marks the 6th consecutive year of silver market deficit. The projected shortfall for the year alone is 46.3 million ounces. Since 2021, cumulative silver inventory drawdowns reached approximately 762 million ounces. They had about 9 months of global mine supply consumed above production. That inventory is gone forever. It went into solar panels, semiconductor wafers, EV battery systems, and circuit boards, now operating inside devices unlikely to be recycled soon. Meanwhile, COMEX registered silver inventory, the metal backing warehouse warrants deliverable against futures contracts, at roughly 79.88 million ounces in mid-May. Total open interest in silver futures stood at approximately 576 million ounces, representing a coverage ratio of 13.4%. Exchange analysts flag anything below 15% as stress territory. This marked the 7th consecutive month under that threshold. In simple terms, for every ounce of silver physically deliverable at COMEX, there are roughly 7 paper claims on the same ounce. The paper market is increasingly unbacked by real metal, a trend that has continued 7 months straight. Despite headlines focusing on a $12 price swing and demand pressures persisting, nearly 2/3 of silver mine supply comes as a byproduct of other metals, primarily zinc, lead, and copper. Silver supply cannot quickly respond to price increases like a dedicated silver mine could. Facility operators focus on zinc and copper, not silver, which emerges alongside. When a dust extraction unit in Kazakhstan explodes and halts production, no alternative source can immediately compensate. Silver supply remains structurally inelastic, a fact many investors underestimate. Adding to this, the Iran war has impacted energy costs. Gold Fields, a major mining company, quantified this for the first time in its first quarter 2026 results. At $100 per barrel of oil, the energy shock from the Iran conflict adds $40 to $50 per ounce to mining operating costs worldwide. This cost is real and flows directly into the economics of every silver-producing operation. Higher operating costs makes a marginal production uneconomical. Supply that was already tight gets tighter. All of this, the 6th consecutive deficit, the Kazink explosion, the COMEX coverage ratio at 13.4%, the structural inelasticity of supply, and the energy cost shock, was absent from the Beijing agenda. The summit ended without a chip deal. Silver fell $12, but fundamentals remained unchanged. When silver rose from $75 to $87, media coverage framed it around Trump and Shea summit optimism and trade deal hopes. When it returned to $75, the narrative was summit disappointment, silver sells off, trade done. Almost nobody reported the gold-silver ratio signal that indicated this move was industrial, not speculative. Few mentioned the Kazink explosion or its implications for an already historically tight supply. The COMEX stress indicator has remained below 15% for 7 months. The $12 pullback is real. Those who bought silver at $87, expecting a comprehensive US-China AI trade framework, were positioned for an outcome that did not occur. That is not a failure of the silver thesis. It is the difference between a positioning trade and a structural investment. The structural investment thesis rests on the deficit. 6 consecutive years, 762 million ounces of cumulative drawdown, supply that cannot respond quickly to higher prices, and demand that continues growing from solar, EVs, AI data centers, and military electronics, all with no substitute for silver and no reduction in consumption. The thesis did not change last week. The price did. Those are distinct realities. If you understand the difference between a price move and a structural shift, you are ahead of most retail investors who only see numbers go up or down. The US-China trade truce underpinning last week's summit expires November 10th, 2026, now less than 6 months away. Whatever the summit failed to resolve will return to the table before that deadline. The next positioning ahead of expiry will move silver again. The industrial demand signal that compressed the gold-silver ratio from 61 to 55 in April is not one time. 60% of demand is tied to supply chains running through US-China trade. The next time the ratio compresses toward 55 or below, you will understand the mechanism. The next time silver moves 6% in a single day while gold moves less than 1%, no headline will be necessary. The deficit continues, 46.3 million ounces this year alone. Cumulative drawdown has consumed 9 months of global mine supply since 2021. Eventually, the physical market catches up to the paper market. At some point, the 13.4% COMEX coverage ratio will not just indicate stress, it will signal a breaking point. Last week's $12 move was noise. The 6-year deficit is the signal. The AI supply chain that propelled silver 16 times faster than gold on May 11th remains intact despite the summit ending without a deal. That is what changes. Stay sharp. Please leave your thoughts about this content in the comments below. Thanks for watching. See you in the next one.